Hi everyone, my name is Jonathan Snow and I'm a licensed financial professional. Today we're going to look at the retirement account from the future. But first I wanted to educate a little bit on money and specifically investments that people are pushing as the better retirement accounts. There are three main ways that money grows. In a bank account, money is growing at a fixed rate because you're getting less than 1% interest, so you're not going to see very much growth at all. The second way money grows is in a variable strategy. This is like the stock market, crypto accounts, 401ks, Roth IRAs, any IRAs, mutual funds, index funds. These are all variable strategies. This means your money goes up when the market will go up or the index goes up. When it goes down, you lose money. You're not protected or you have no guarantees at all. The third way that money grows is indexed. This is like an IUL or an indexed life policy. Your money participates in the upward trend, so when it goes up, you're gaining interest, and when it goes down, you don't participate. You don't lose any money at all because you don't participate in this downward trend. You just stay locked in. Let's compare investing into the S&P, which is a variable strategy, versus an index strategy. You'll see this index strategy has no negative numbers. It's only going up. And this is because you never participate in that loss, in that downward trend. Whereas the S&P is always going to be going up and down just as easily. There's no market protection at all. The main difference is with this index strategy, you're always growing money on that higher balance. You're never actually losing money and going negative. Some of the biggest banks and also companies in the world use life insurance, and they put billions of dollars into this life insurance asset. And this is for three main reasons. This is the ultimate in safety, stability, and growth. Banks like to keep their wealth in cash value life insurance and treasuries, but let's look at where most Americans are keeping their wealth. Most Americans keep their wealth in bank accounts, stock market accounts, 401ks or Roth IRAs, but some even have an IUL. Let's compare the differences with these type of accounts. With the bank account, like I said, you're getting less than 1% interest. Inflation is really high right now, so you're losing money every day in a bank account. In the stock market, you can gain money and lose money just as easily. It's very risky. That's why it's called a variable strategy. There are capital gains taxes in stocks and crypto, all of those type of accounts, and they're not very liquid because you can't access your money right away. Sometimes you're penalized or taxed for accessing your money. With 401ks and Roth IRAs, you can't access your money until 59 and a half most times, which is locking your money in money jail. There are a lot of taxes for accessing your money early or accessing your money too late. It's not a flexible account. There's contribution limits. You can't contribute over 60,000 in most cases with Roth IRAs. With an index fund and mutual fund, there's also no downside protection. You're able to grow money in this market and also lose money just as easily. It's not liquid because you don't have a lot of access to your money. It's not tax-free and penalty-free because it's going to grow in a tax-deferred strategy in most cases. And there's no cash value account, meaning you don't have access to the insurance carrier's money or whoever has your money. Most of the time, like an Edward Jones account, there's no cash value. You're not able to access their money at all while your money is growing in the account. Very common rebuttal I hear is you can't use life insurance for retirement income. You can't use life insurance to grow your money. Index funds are better. Mutual funds are better. Just invest the difference. Life insurance is not investing. Whole life sucks. You're technically right. Life insurance is not investing because life insurance has no taxes. Life insurance has many guarantees these investments don't offer. Investing the difference won't work. They'll just be investing into these accounts with zero downside protection and no guarantees. Most also don't even know where to invest their money. They'll just be buying liabilities instead of assets. Now let's look at an IUL, Indexed Universal Life. This account is liquid because you have access at any time, penalty and tax-free if it's set up correctly. You're market protected. You have guarantees in this account that those other investments don't have, like a 0% floor rate. That means when the market goes up, you're going to gain that interest. And when the market goes down, you don't lose any money at all. You stay locked in at 0%. You can never get negative interest. You have tax-free growth with tax code 72E. You have tax-free access to your funds and the cash value because of tax code 7702. You have a tax-free transfer of the death benefit to the beneficiaries with tax code 101A. And this account is special because you have uninterrupted compound interest. This means the money growing in your cash value will be uninterrupted even if you take a loan out because you're able to borrow the insurance carrier's money. Your money will keep growing interest in that account like it never left. The catch with the IUL is not everyone can qualify. You have to be healthy. They want to look at your medical history to see if you have any terminal illnesses. You can't be a convicted felon, and you can't have 2 or more DUIs. Now that I showed you the differences between those investments as retirement accounts, let's look at a policy of someone using this IUL as a retirement account. This client is going to be 45 in the very beginning, and they're contributing $100,000 a year. This account is designed for a tax-free retirement income, meaning they're going to stop contributing when they get to 65 or at age of retirement, and this account will then pay them tax-free retirement income. You're able to get that tax-free retirement income because it's mixing Nationwide's money, the net surrender value, with your death benefit and distributing it back to you every single year. So they're only going to be contributing $100,000 every year up until 65. They stop and they've contributed $2 million in total. They're going to get $461,000 tax-free every single year until they pass away. As you can see here, they're getting money every year, 100% tax-free. And this is possible because they're mixing your death benefit with the net surrender and distributing this back to you. At the age of 95-ish, when you're going to most likely pass away, this account stops distributing to you, and your family will receive your death benefits still 100% tax-free and penalty-free because of the guarantees in this contract. So you were able to get $461,000 from ages 65 to 95, 100% tax-free and penalty-free using the IUL that I structure. And remember, this is all at a 7% illustrated rate. The actual performance of the index I select is right here. We use the Global H Factor High Par Select Index because this is an uncapped index that has been averaging 17.5 for the last 30 years. This is only possible because this index has one of the highest multipliers, which means the interest accrued that year will be multiplied by this participation rate, and it's getting this high average because of that. I'm a licensed financial professional, and I can structure this exact IUL with you in a free Zoom consultation where we can discuss your financial goals. Just click my link to meet.